Is HIMS a buy at $33 per share? And if you want to build indestructible generational wealth, is HIMS a good choice as a long-term investment? The only way to know is via fundamental analysis to find the intrinsic value. I spent the last week putting together a full fundamental analysis of HIMS based on their recently reported 2024 results. Trading at $33 per share, I currently have a sell rating on HIMS stock. In my research, I discovered 6 things that got me very excited and 4 red flags to watch out for with HIMS. So what did I discover? What is my value for HIMS stock? And what's an ideal entry point should you decide to become a HIMS shareholder? Let's dive in and find out. Shout out to Amir Raza for suggesting this week's company. In this video, I will cover HIMS recent results and what everyone is missing, what I think about HIMS stock and what my analysis uncovered, what Wall Street smart money says and how it can impact your portfolio, and how you can use this information to build wealth and what you must do if you decide to buy. Are you an investor in HIMS stock? Why or why not? Let me know in the comments below. HIMS recently reported record-breaking 2024 results, and I'm going to break it all down for you. Let's cover the red flags first. Their regulatory model relies heavily on not being classified as a traditional healthcare provider. Any change in telehealth or pharmaceutical fulfillment laws could disrupt growth plans overnight. Short interest has increased 2.5 times over the last year, and this could weigh heavily on the stock if there's any bad news, and it will lead to more stock price volatility. Marketing spend grew over 50% last year and is the key to future growth. Customer acquisition costs could be nearing saturation in some verticals. HIMS trades at a premium multiple based on growth assumptions. Any subscriber deceleration could mean a major stock decline. And just to give you some perspective, HIMS trades at 83 times EBITDA, while Nvidia trades at 31 times EBITDA. That's 2.7x higher.
Oh, that's high.
Here's what got me really excited. They made a foundational shift from niche men's health to full spectrum personalized care across weight loss, dermatology, mental health, sleep, and hormone therapy. 69% year-over-year revenue growth, crossing $1.47 billion in total revenue. Average order value surged 41% to $137. And get this, over 2.2 million subscribers are now on the platform, a 45% jump year over year. HIMS owns its own compounding facilities, its own pharmacies, and even a peptide manufacturing and lab diagnostics business. This creates major operating leverage. This means higher switching costs, longer retention, and more predictable revenue. HIMS will now offer the FDA-approved weight loss drug Wegovy through its telehealth platform. They will provide a comprehensive package that includes all dose strengths of Wegovy, 24/7 clinical support, nutritional guidance, and access to Novo Nordisk's NovoCare pharmacy starting at $5.99 per month.
That's a deal.
This is what everybody is missing. The rollout of the MedMatch AI engine will lead to enhanced dosing and treatment personalization. Plans for AI-powered health coaching, personalized treatment insights, and digital therapists creates a competitive advantage. When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's 3 financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
Nah, thanks.
That is what you are doing when you buy a stock without understanding the 3 financial statements. If you want to value companies like the world's top financial analysts on Wall Street, check out my school community, Win Like Wall Street. Just scan the QR code on the screen. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. Cash has tripled from 2020 to 2024. With over $300 million in cash, they are actively investing in research and development and trying to scale the business. Despite massive growth, HIMS is not being funded by debt. In fact, they have 0 debt. In February of 2025, HIMS announced a new $175 million revolving credit facility, which allows them to access financing if and when they need it. The accumulated deficit became less negative in 2024 due to positive net income. We will see this next in the income statement, and this is a massive financial step forward for the company. So what's the takeaway? With a conservative balance sheet that contains a stockpile of cash and no debt, HIMS is ready to take advantage of growth opportunities. The income statement shows us if a company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way that we determine how effective a company is at generating profit is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Annual revenue growth has averaged over 78% over the last 5 years and was over 69% last year. 2024 saw HIMS generate over $1 billion in revenues for the first time, and they are just getting started. While gross profit has been positive and growing over the last 5 years, last year saw a decline in gross margin from 80% 82% to 79.5%. Margins dipped slightly due to higher marketing, but that's expected during a supernormal growth phase. In 2024, EBITDA, EBIT, and net income were all positive for the first time ever. This is a major positive for the company and its valuation. So what's the takeaway? The numbers are looking great, but as they transition to more normalized growth, they need to keep an eye on managing costs effectively. The cash flow statement tells us where the cash is generated by the company, and there are three buckets. Operating, which is the cash that the company generates internally, investing, which is the cash demanded for long-term growth, and financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making this positive, not losing cash, which would make this negative. Free cash flow went from 56 to 209 million, almost a 4x increase. CapEx is relatively low, so any increases in operating cash flow provide a nice boost. Proceeds from investments over the last 5 years was almost $833 million. This is the money that they are making on their invested cash. This provides a nice source of cash that is outside of normal business operations. While the company does not pay a dividend, they repurchased $83 million of shares last year. The company approved a new $100 million plan last year, and there's $65 million remaining. The share repurchase program can provide support for the share price, especially amidst volatility. So what's the takeaway? Operating and free cash flow are positive and growing rapidly. With this abundance, HIMS has rewarded shareholders by returning tons of cash to them, which is a huge positive. So what does this all mean for the valuation of HIMS stock? Let's cover that next.
Yes, sir.
On Wall Street, we build discounted cash flow models to measure the intrinsic value of companies. Because companies generate cash flow and we projected the three financial statements, we could take these future cash flows, discount them back to today to get a current intrinsic value of the company. We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to value companies like we do on Wall Street so that you can build generational wealth, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video appears above and is in the description. As you can see on the left, we take specific line items we projected from the three financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get the total enterprise value. We strip out the debt, we add the cash, we strip out non-controlling interest, we add associate investments, we get an intrinsic equity value of about $6.8 billion. When we divide that by the current shares outstanding, we get an implied share price of $30.61 compared to the current close of $33.10. That is a 7.5% premium, which is a sell rating. On Wall Street, if a stock is trading at more than its intrinsic value, it's a sell because we don't want to pay more than it's worth. So what does Wall Street have to say about HIMS stock, and how can that impact your portfolio? Let's cover that next.
And I'm ready, sir.
Analysts express cautious optimism about HIMS and Hers Health, balancing its innovative approach with potential regulatory and competitive challenges. Bank of America has a $26 target on HIMS. They maintained an underperform rating, citing concerns over HIMS' reliance on compounded weight loss drugs, which may face regulatory challenges. TD Cowen has a $30 target on the stock. They downgraded HIMS from buy to hold, expressing caution over the sustainability of its rapid growth and increasing competition and regulatory scrutiny. Morgan Stanley has a $40 target on HIMS stock. They kept an equal weight rating, noting that while HIMS has growth potential, the shift to branded GLP-1 drugs could compress margins. CapIQ gives me a sense of how other analysts on Wall Street view the company. Only 14 analysts cover HIMS stock on Wall Street. The target price ranges from a low of 25, which is a 24% decrease, to a high of 85, which is a 157% increase. The median is 36.50, which is a 10% increase. The overall rating on a scale of 1 to 5 is 2.71, which is a hold rating.
You should seek the advice of an investment professional always. I do not know your individual financial situation. This content is meant to educate and is not investment advice.
That being said, I do not own a position in HIMS, and the 23% one-day pop after the Wegovy news kind of took the discount away pretty quickly.
It is what it is.
If you decide to buy HIMS, you need the right entry point, which I will reveal shortly. With Keeps, Roman, Muesli, and even Amazon and Weight Watchers, HIMS has a lot of competition to fend off. They are the only vertically integrative service, which does give them a big advantage. Weight loss, hair loss, mental health, and now new plays in sleep disorders, fertility, and even testosterone optimization. Each of these areas has a total addressable market of over $1 billion. The $100 million share repurchase program approved in 2024 with 65 million coins still available indicates potential support for the share price. Strong traction with mobile influencer marketing and direct-to-consumer conversion. HIMS is not just a website. It's a full-blown consumer brand that meets people where they are. Think Amazon meets Walgreens. HIMS hit a 52-week high of $73 in mid-February 2025, and it's down almost 55% since then. In the last year, HIMS is up almost 165%. My model shows a valuation of $30.61, which is a 7.5% premium at current levels. On Wall Street, we buy with a margin of safety of at least 20%, so HIMS is a sell at current levels. But if you're interested in buying HIMS, I would be looking to buy below $25.50 in the $20 to $25 range. If you like this and want to see another in-depth stock valuation, check out my NVIDIA video here or my PayPal video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.